Welcome back. So we're going to jump right into the historical financials of Alibaba. I have every quarter going back to about 2015. If you want more of the story side of the investing and its market, where it stands with its competitors and stuff like that, I feel like a lot of other channels do a good job answering that. And you can even just ask ChatGPT, in my opinion. But in general, I feel like the finance and investing YouTube channels are lacking the tactical practiced approach of investing. Like, how do you actually go through the financials, see what looks good, what looks bad, that sort of thing. Okay, so anyway, that's what we're gonna do. All right, so total revenue, I'll tell you one thing, this is what you want to see up and to the right. This is an amazing graph. I mean, revenue's growing since our original data point is $17 million here, or no, I'm sorry, it's not dollars, it's in the Chinese currency. At the end, we're going to convert, so I'm going to keep everything in the Chinese currency for now, and then at the end we'll convert to dollars once we do the valuation. All right, so about 17 million or 17 billion yuan, okay, per quarter, and now we're as high as 260. Okay, so what is that compounded? 2014 to 2024, that's 10 years. So to do that math real quick, you do 260 divided by 17, you raise that to the 1/10, and you will get that that's a 31% compounded growth rate. All right, is it going to grow at 31% from now on? No, right? But I just think that's impressive. To get a growth rate later on, we're going to use more of the cash flow, and we'll get to that. Okay, I just thought this was impressive. One thing also that you want to look at, if the revenue's growing, you want to make sure gross profit's growing too, right? We're not just sacrificing margin for sales. And sure enough, gross profit's definitely on that same up and to the right trajectory. Operating income, same thing, right? A little bit more muted, I would say, which tells me that the operating expenses have gone up somewhat in proportion to the gross profit, but it's still increasing. What's interesting though is that you look at pre-tax income, and that's actually kind of relatively flat, and I mean really low these recent quarters. Now, it's strange for a company with very little debt like Alibaba to see a big change between operating income, meaning like the pattern of the operating income, versus the pattern of the pre-tax income. Because if you don't have a lot of debt, the only things in between those two are going to be interest payments and then other expenses. So what's going on in this scenario? It's not going to be debt, right? Because it's not going to be interest because I've told you they don't have a lot of debt. It's going to be this other income, and let me get it, other income expense. I mean, yeah, we've seen, look at this, big negative recently. Okay, so what is that? Best thing to do, I mean, that's close to 10 billion yuan in one quarter. The best thing to do is to go consult the 10Q report, or I don't know if it's called the 10Q, but the latest quarterly earnings report. So I have here Alibaba's December quarter 2023 results. I know I'm a little late, February 7th, but we'll still go look at what the other income is. So you type in other here, Control F, other income. All right, sweet. So we have this description that other income was, okay, it's actually a positive. So that's usually what you have to do, but in this specific case, it looks like they combine their interest and investment income. I mean, that kind of makes sense to me, combine some of your investments are in interest-bearing securities, right? Like if you own corporate bonds or something like that. So combining them makes sense. Anyway, the interest and investment income was a loss of 3,500 million or 493 million dollars compared to a gain of 15 million in the same quarter. So basically what's going on is it's a lot like Berkshire Hathaway, I think, where they're forced to account for unrealized movement in their portfolio in their income statement, which is why I think it's more important to look at, and I'll go back here at operating income, because that's going to be, I guess, more indicative of how the company's actually doing because of this stupid accounting thing with unrealized gains and losses. I mean, Warren Buffett writes about that almost every year in his letter, and I think it applies to Alibaba as well. The real fix to all of this, though, is to just judge cash flow. And we're going to get to that at the end of the video, and that's actually going to be what we do to value the company. But before we do that, I'm going to show you the balance sheet real fast because it's got some really interesting stuff with the balance sheet for such a high dollar company, right? All right, so first thing with the balance sheet, look at this total assets, 1.8 billion yuan compared to, compared to total liabilities of roughly under 700. Okay, so you're talking oh man, I said billion, it was trillion on assets, right? So yeah, $1.8 trillion in assets, not dollars, trillion yuan in assets. And then liabilities is less than 700 billion. So, if you look at the top right of my screen, that market cap, the 1.33 trillion yuan, I mean, you're looking at close to a PB of 1, a book value of, let's see what the book value is, total equity. Total equity is roughly, close to 1.2 trillion yuan, and the market cap's 1.33. So for such a big company and a tech company, you're not going to see something with that good of a balance sheet. And just to drive that home a little further, one thing that I always like to look at is the current assets. So this number right here, this 800 billion, versus all of your liabilities. So are you going to be bringing in enough cash in 1 year? That's what current assets is. It's like the cash that you're expected to bring in within a year, or due to become cash in a year, to pay off all of your debt if you had to. And the answer is yes, because remember, the current assets was 800 billion and we're at less than 700 for total liabilities. So really, really strong balance sheet. And, just one more thing, I love to always look at tangible book value. And I don't really care what this is as long as it's positive and growing, because to me, that's a sign of good management. And if you want to be more precise, you'd probably want to look at tangible book value per share to make sure that they're buying back shares. Now, if a company's paying dividends, obviously that'll not help your tangible book value. So just keep that in mind. But in general, I really like to look at tangible book value. All right, cash flow, like I promised. Now, on Yahoo Finance, which is where I get all my data, the only things available to me are like the big buckets: operating cash flow, investing cash flow, financing. And this is every quarter. So anyway, we'll just go through them like this. Operating cash flow, this is going to be all the cash that the business brought in from its operating units, hence the name, right? Anyway, the last 4 quarters have been about 190 billion yuan on average. Not on average, but totaled 190 billion. All right, next I want to look at financing cash flow, because I think this is really interesting. If you're looking at a company, a great way to kind of find a guaranteed return is the financing cash flow. A lot of people look at dividend yield as like, okay, if I buy this at a 3% dividend yield, then I'm guaranteed to get 3% at least, right? Financing cash flow combines repurchases, which Alibaba is doing a lot of. It combines that with dividends, with debt pay down. So in my opinion, it really is like a direct shareholder return. So the things that come out in financing cash flow are really directly affecting you as a shareholder. So I'll go some like the last 4, maybe I'll do the last 8. So take a 2-year average. So this is the last 8 quarters, averages 16.3 billion yuan per quarter. So 16.3 billion. I'm going to multiply that by 4 to get to a yearly number. So that tells me 65 billion yuan per year in financing cash flow. So I'm going to divide that by the market cap, which is 1.33 trillion. So, that gets me to about a 5%, and I'll multiply by 100 to get to percent. So 4.9% financing cash flow yield. So financing cash flow alone is giving you, I'm going to say 5%, right? And most of that is repurchases. So just with that alone, you're getting that 5%. So that's going to come in later in the growth equation. All right. Now let's go to operating cash flow. Oh, no, I'm sorry. Investing cash flow. But it's hard to determine with Alibaba, based on some of these American data companies like Yahoo Finance or whatever, what this investing cash flow is. So is it all investments? Is it CapEx? Because you look at it right now and you say, okay, this is an average of 17 billion per quarter. And if I go to my operating cash flow, I'm averaging 47 billion per quarter. So 47 minus 17 is 30, right? So 30 divided by 1.33 trillion is only a 2% free cash flow yield. That was if you assume that free cash flow, that all of that investing cash flow is CapEx, okay? That's not the case. So just be careful falling into that trap. Don't just look at investing cash flow and assume all of it's CapEx. I know that might sound silly, but sometimes that's a trap. Okay. So we're going to pull up the 10Q again. This time I'm going to use the Control F to find capital expenditures. All right. Capital expenditures of 9. See, it's confusing because it says 9,000 million. Okay. So to me, that's just 9 billion RMB, which is the Chinese currency. So 9 billion per quarter, let's say. So keep that in mind. I'm going to round up to keep it simple. I'm going to say 10 billion yuan per quarter in CapEx. Okay. Remember that number. Now we're going to go to operating cash flow on a trailing 12 months basis. So basically what I did was I took the operating cash flow and I just did a trailing 12 months, which meant that each data point is the sum of the previous 4. And what it does is it smooths out the curve for me to get rid of that noise. Obviously the first 3 years can't count because anyway, it's the sum of the previous 4. Anyway, so operating cash flow, trailing 12 months, looks like it's hovering about 200 billion yuan. You know that. Now this is the key question, right? Do you think that it's going to continue to grow on this kind of trajectory? Because if you do, now it's a no-brainer, I think, as an investment. Who cares what the CapEx is? You know, if you're going to be making 250, 300 billion yuan on a yearly basis, an operating cash flow, you know, it's a no-brainer. Because one thing with Alibaba is once it reestablishes growth, not only are the earnings going to go up, but then the PE is going to go up as well. So you're going to get this compounding return, right, where you're getting a higher PE on better earnings. I'm going to be a little more conservative and say that my starting point is going to be this 200 billion on a yearly basis, okay? So 200 billion yuan. I'll do it like that, 200 billion. And then remember on CapEx, I said 10 billion per quarter, which means 40 on a yearly basis. So 200 minus 40 means my free cash flow that I'm calculating is about 160 billion yuan per year, starting free cash flow. And then we'll go growth in a second. But just real quick, like what is my baseline yield on free cash flow? It's going to be 160 divided by 1330. That's a 12% free cash flow yield on something that could be really growing. So, I mean, just ballpark that it seems undervalued, right? I'm just noticing 1 second that I have 3 T's in there. It should only be 2 T's on trailing 12 months. Just wanted to point that out in case you were confused. All right, let's go to the discounted cash flow model. All right, so what is my free cash flow going to be? It's going to be 160. Oh, no. I want to switch back to dollars. I'm sorry for anybody who's following in Chinese currency, but 160 billion yuan. The conversion factor right now is 0.14, which I feel like last time I did this video it was 0.16. So that alone is hurting your returns as a U.S. investor. But anyway, all right, so that turns into $22.4 billion. So now I'm back in dollars. All right, $22.4 billion. I always discount at 15%. You don't have to discount at that. I recommend that you discount at the same value for every company. That's all I recommend. You know, don't change your discount rates in between different companies. All right. 5-year growth. All right. So right off the bat, 5% I think you're getting from your financing cash flow. So now let me go back to the operating cash flow and try to figure out a growth. All right. So to do that, I'm going to take this peak here, which was roughly 2019, 150 to, let's say, 200. So 200 divided by 150, that is 33%. That happened in 4 years. So you're going to raise it to the 1/4, raise to the 1/4, and you get a compounded growth rate of about 7.5%. Okay, so I'm going to knock that down a few points and add the financing one. I mean, if I add the two together, I get 5 and 7.5. So I get 12.5% growth in the next few years. So I'm going to knock that down to 10%. Okay. That's just, my assumption. You can do whatever you want here. Perpetual growth, I'll say 3%. All right. That gives me a net present value of $230 billion on the market cap. Okay, so market cap right now is $187 billion. You can see up in the top right. So 230 divided by 187 means that it's about 23% upside. And I multiply that by the current share price. And that gets me, let's say, fair value $92 a share at those assumptions. Now, I am big on margin of safety. I use a big margin of safety. I would say in general, I feel like this margin of safety plus the high discount rate has been a little too conservative. I've missed out on some big winners because they just didn't quite get low enough. So, there's that. But once you apply a margin of safety of 67, I should say, once you're trying to buy at 67% of fair value, now your target entry price is $153 billion market cap, which would be divided by that times 75, which would be a stock price of about $61 a share. All right, I think that's a little harsh. I think also, if you change these assumptions at all, that the equation really starts to change and can get very favorable very quickly. Just look, if you do, like, some people discount at 12%, 80% margin of safety, 12% growth. This is a little crazy, but it's easy to see. Like, I could easily see that this happening, this scenario playing out where, it's probably worth $330 billion in market cap, which is approaching a double, not quite, but I could see that scenario playing out. Like, I wouldn't be shocked if that happened. I think what I'm doing is just trying to be a little more conservative. Also, okay, what am I doing with Alibaba? I'm 100% invested in the United States. I don't, it's not that I don't like other countries. It's that I don't feel like I know what's going on over there. There was a really neat video I saw on somebody giving a huge presentation on Alibaba, and he really compared it to Microsoft and how for a long time Microsoft was just continuing to increase revenue, increase profits, but it was getting beaten down in the market. And he compared Alibaba to that. And if you look at the revenue graph and stuff, it looks the same way, right? But my issue is, if you were in the US at the time, you could see that Microsoft was still ingrained in all of the companies. It was on people's personal computers. Like, it wasn't going anywhere as a system. There are some fears of Alibaba getting some market share erosion from, like, either JD, Baidu, Tencent, all the above. I have no idea what's going on in that market. Like, I don't interact with any of those platforms, so I don't feel like I have any advantage, but that's just my take, right? Please let me know what you think, comment, give me some more suggestions. Suggestions have been great for the channel, so I appreciate those, and I'll see you next time.